start because we all know that partnership tax goes quickly, right? It may have other issues, but boredom and repetition is now one that seems to cover a lot of the new material. So let's pick up, let's talk about where we are in the larger scheme of things, what we're doing today, and what the future has in store for us. Just make a, oops, I should do something, but you guys got me so excited about starting class, I forgot to start recording us. So hopefully this will start working and then we're official. All right. So we're recording now. We're just getting started. And in terms of what we're doing, or we've been, and notice, by the way, if there's any solace, because there is a lot of information to absorb, that numerically, in terms of pages, we're not covering as many pages as we did the first half. So if you're driving yourself nuts and saying, oh my God, look how many pages, you'll see that we're at a much slower pace. That doesn't mean there's not a lot of information. So don't think I'm just saying this, but there's fewer pages, okay? And that's not a bad thing for you guys, hopefully, to catch up and do what you need to. Now, in terms of material, guys, as promised, chapter 1 is becoming, I think, easier to read for those who like to go back and review things. I think that's going to sit well with you in terms of, hey, you can really understand chapter 1. I like to think so. Chapter 2, formation issues. Again, the very last day of class, which people pointed out, no, we do not have class the day before Thanksgiving. As much as I'd love to be here with you, we do not have class. Spiritually, we will be together, I am sure, but we won't be physically together. But even that last day, when we really get into the meat and potatoes of liquidations, we can, that same day, talk about 721 transactions. They can happen the moment before the partnership terminates. All right, so just know that. And it can happen once, it can happen twice, it can happen a lot of times during the life cycle. Chapter 2 also introduces us to the concept of partnership liabilities. Why? Because partners often contribute property subject to liabilities early on. So also know that. We talked about organizational and syndication fees, and talked about the fact that, geez, Code Section 709 is very similar to Code Sections 195 and 248. Been there, done that. You guys know generally it's a 15-year amortization rule. Operations of a partnership. We talked about just how partnerships in general operate, basis adjustments. It's kind of funny. Someone raised an issue just yesterday with me in a meeting and talking about their S corporation and what basis they had from an S corporation they formed 30 years ago. And just so you know, S corporations are very similar to partnerships. The tax basis of an S corporation goes up and down just like a partnership. The only difference, a partnership has a basis adjustment for liabilities where an S corporation does not. There's no equivalent in the S corp realm to 752. So, but people were, the accountants and the financial planner were saying, oh, how much did you invest in 1995? Because that's your basis in your S corporation. And the point is, you guys know, I hope, that even when you're dealing now with S corporations, hopefully your knowledge base here, don't use this course wholesale to apply to S corporations, but many of the concepts are very similar in this realm and the S corporation realm, all right? So know that your knowledge base is increasing a lot, I like to think, with respect to S corporations. And like my larger point is a lot of basis fluctuation, right? Annually under Code Section 705. Then we talked about Chapter 4. George has to chime in. Where's George? Where are you, George? There you are. What do we need, George?
Substantial economic effect.
Yes, substantial economic effect, right? Substantiality is going to be measured by transitory, yes, and shifting, right? But as long as you reflect it in the capital accounts, generally, it's going to be respected. One or two caveats. Sometimes Partnerships are to have unlimited deficit restoration. That's okay if it doesn't, as long as it has a so-called qualified income offset. And non-recourse deductions, right? Non-recourse deductions have no economic effect, right? They have no non-recourse deductions, but as long as there's a gain chargeback, right? If there's a gain chargeback, then that allocation will be respected. In other words, if you get the deduction, as long as you're responsible for subsequently picking up the gain, that's going to be okay, right? So then we talked about Chapter 5, because Congress is as magnanimous as going to be that to respect the allocations as long as George says. Generally, there's substantial economic effect. Nevertheless, there has to be certain safeguards, because otherwise taxpayers, knowing our brethren taxpayers and tax planners, would go hog wild. Chapter 5 points out safeguards. In particular, contributed property, right? You can't allocate gains and losses of contributed property away from the contributing partner. And we're going to see that emphasized today with respect to operating distributions. Everyone get that? That if you contribute property with a built-in gain or a built-in loss, either one, that's going to be like glue, right, to the contributing partner. He or she cannot shed that. Right? Generally, I'm going to say generally because there's always exceptions. And we're going to see that with respect to operating distributions as well. So we saw that allocations, that with respect to sales of contributed property, they have to be allocated generally to the contributing partner, and also depreciation deductions. There's special rules as well. All right, so that's, and then we talked about family members where there's the possibility for collusion and where partners' interests vary. Chapter 6 talked about partnership liabilities, and again, I don't know if you'll remember all the particulars, but we know Code Section 752 that with respect to recourse liabilities, Ramon, how are they generally allocated? Say it loudly. EK, do you agree? Say it loudly, because the people on the WebEx are going to get mad. They can't hear you. Based on loss, right, Ramon? Not your day to go to Atlantic City, right? Red or black? I'm going to take whatever you say, the opposite, right? All right, but you know, with recourse liabilities are generally allocable with respect to if all the partnership assets became worthless. Conversely, with respect to non-recourse, EK?
Based on profit.
Generally based on profits. All right. Compensating the service partner. We talked about there's several ways to do it. Treat them as a non-partner, guaranteed payment, distributive share, right? 707A1, 707C, and just normal distributive share rules. Jacqueline, where are you? You're not here. Are you on WebEx? You're not on WebEx. Maybe you're listening to us on tape. We're missing you here tonight, Jacqueline. Because if you were here, Jacqueline, I'd ask you about compensating a partner, right, Jacqueline? And I'd ask you, what would happen? Anyone want to play the role of Jacqueline tonight? Michael, what would Jacqueline have said if she were here tonight with respect to the receipt of a profits interest taxable or not, Michael? Generally, just be careful. Generally not. Everyone understand? Because if you tell your client not, they will run with the ball at your expense. Okay? And Michael, if you get an equity interest, capital interest, generally taxable, right? Code Section 83, the receipt of property in return for services, generally taxable, unless it's forfeitable, right? Unless there's a risk of forfeiture. All right? Now, obviously, there's some other rules there, but these are general concepts that, guys, we're not going to be meeting, in 2020, last I checked my calendar. But you guys got to take this knowledge base outside the classroom and be able to apply it. Again, You're not going to remember all the details, but some of these general concepts, this is what you do for a living, you got to carry with you for life, right? So get these down, all right, please. Want to make sure your Wednesday nights, or when our Wednesday nights together, are well spent, right? Property transactions between partners and partnerships. All right, we spoke about these transactions and the fact that anytime you have a transaction with a related party, congressional antennas go up, right? And that may result in otherwise capital. If you recognize a gain, that gain may, akin to Code Section 1239, give rise to ordinary income. Okay, we saw that in the realm of 1239, and now in the realm of partnerships. If a related party sells to a partnership, may give rise to ordinary income. And if you sell to a partnership, or a partnership sells to a partner, that loss may be disallowed, right? But these concepts, guys, are endemic throughout the code, right? These are not concepts unique to partnership, all right? So that's the good news. The more you pick up on some of this stuff, the better served you will be, or at least I hope so. All right, then we turned, and let's just look more particularly, as opposed to from 30,000 feet up, let's just look at chapter 9, and then we're going to really dig into chapter 10, all right? So let's just look at chapter 9, because chapter 9, chapter 9 deals with consequences to the selling partner and consequences to the buying partner, right? So make sure for exam purposes, or if you're working with a client, you label and identify who's the buyer, who's the seller. And even if you're working from one side of the equation, right, guys, as a good tax accountant, it's always important to know what are the tax consequences to the other side, because that may calibrate how much economically you should instruct your client that, hey, this is a good deal for opposing, for the buyer, so you should command a greater price, or, hey, I understand why the buyer is not offering you so much because of the draconian tax consequences. So, in my opinion, it's obviously, I'm saying the obvious, you should know both sides, your client's position and why the opposition is taking its position, right? Will make you much, much stronger, more valuable to your client. All right, so we did talk past tense about consequences to the selling partner. And in general, Jonah, what is the tax consequences? By the way, for those who did not come on Saturday night, it was fun. I'm going to be a bit biased and say it was fun.
It was fun.
And some of the energy, I noticed, both V and Jonah are sitting together. The energy in that corner during Family Feud was off the charts. So I just want to say, as a casual observer, well, V always has a sort of energy penetrating, but Jonah had the vibrancy was coming through. All right, so Jonah, with the same vibrancy, what are the tax consequences to the selling partner in general? What if you sell your partnership interest? How do you characterize the gain? Generally.
The video. The dance.
The dance. I see 3 fingers. And Michael, you're going to say? All right. Under what code section? Generally, Diva?
No, first we have to compute the gain and
True. Beyond the steps, let's just talk generally what code section applies here.
751 and 741.
Okay, let's start with 741, okay? Because, again, order is important here. Everyone agree? And 741 dictates that, in general, it's a capital gain, right? But then it's trumped by code section 751, right? So again, I'm hoping, look guys, I supplied an outline of the material of these chapters, but take my outline and don't just say, okay, I'll use it. Use it. You can use it, but use it and make your own notes on it, or toss it in the garbage can, but proactively put together each one of these chapters, try to get to a page or two that would be useful for an exam. You may not look at it during the exam, but your preparation of it to organize your thoughts will pay back in droves. Just by so you must. When I say you must, you don't have to do anything. But I want people to succeed. I want them to do well. I want you to really know this stuff. So you got to be proactive because that's going to serve you well. So 741 is the general concept. 750, and there's lots of little things going on here, guys. But the grand concept is Congress doesn't want people to stuff property into a partnership and then just get all capital gains, because we know stuffing property into a partnership, piece of cake if I could snap my fingers. Michael, you were going to comment. You're good? All right. So, and we do our three-step process. And Viva, our three-step dance is what?
First we have to calculate the gain. Then we have
Gain or loss?
Gain or loss. Then we have to pull out the 751 asset, and then the remaining one should be 741.
Absolutely. So everyone got that three-step dance move? Those people on WebEx, we can't see you, but you know, you could be dancing as we were watching, right? We wouldn't know. Except for Peter, because you better be careful, Peter. Well, Peter, you're not here. You're not on tonight, but
I think he
get
is.
your back. Is he on?
I saw him. I saw him say something. You'll have to scroll down.
You know what? Maybe if we scroll down, you're right. I don't know why is this
On the side.
on the side? I'm trying to, but Peter, you there? I see you on the thing. I don't see you on the right-hand side, but Peter, you're there. So be careful, Peter, because we'll get your back and we'll see you dancing behind your chair. All right, so just be careful.
There he is.
There he is, Peter. All right. Are you dancing, Peter? We're waiting. The whole class is waiting. All right. If you want to put on a move, just let us know. Okay. America's got talent. Peter's got talent. All right. So everyone can do that. Everyone understands how to handle this, right? So you flip pages. You know, again, for exam purposes, guys, we're not looking for you to dive deep into the minutia, right? I want you to master the general concepts. All right? Now, that was the first part of the chapter. We did look at capital gains, looked through. We looked at holding periods. We did a little bit on the installment sale. Just little stuff. I want you to know that stuff. Page 328. Consequences to the buying partner. Okay? The buying partner, I said this would be an easy one pager, right? If it were dealing in the corporate realm, because when you buy corporate stock, you take a basis equal to the purchase price. Code section 1012, right? Cost basis. Agreed? Agreed. And in some measure, that is true here. That when you buy stock, or not stock, you buy a partnership interest, it says, Code Section 742 provides a partner takes a cost basis. But that's just this, so we discussed last week, and I think, Tom, you chimed in, you said that 90%, 95% of your client base does not have a 754 election, right?
That's correct.
All right, so, and Ron, I think, did you say so too? I forget it. I don't know who else volunteered and said very small percentage. But you have to know about a so-called 754 election, right? And what a 754 election, when a person buys a partnership interest, ordinarily the inside tax basis is not adjusted. Everyone agree?
Yeah.
Just like when you buy a corporate interest, right? The corporation owns the assets, there's no basis adjustment. But the code permits, if the partnership, at the partnership level, there's a so-called 754 election. If the partnership makes a so-called 754 election, that permits the inside tax basis to be adjusted. When I say permits, it forces upward and downward adjustments once that election is made. And you cannot cherry pick to have an election one year and not the other year. And once it's made, it's in place, and you can see it can cause an upward or downward adjustment. The adjustment amount, Trevor's on, I think on WebEx. Trevor would tell we had some email exchanges today. The adjustment is equal to code section 743B adjustment. And we're gonna see that somewhat similar adjustment under operating distributions under 734. So there's an adjustment between the outside and inside basis or previously taxed capital. And then whatever that adjustment amount is, it's going to be allocated pursuant to code section 755. So, got code section 743B, and the peanut butter jelly is 755. I gotta ask Elizabeth, what are you drinking there? Coconut water, okay. I didn't know it looked special. I don't know. Do you guys like coconut water?
Yeah.
Yeah.
Electrolytes. It's
I
way
know,
better
it's
than
supposed to be very
Gatorade.
good for electrolytes.
Natural and doesn't have the crap that Gatorade has.
It does not have all that, yes. All right, so we talked about, again, you guys can go through it, the effects of buying a partnership interest. Generally, it's a nothing issue, but then if there is a 754 election, it is challenging, right? Everyone agree? Challenging. Then we began our journey into operating distributions, right? And we spent some time talking about the consequences to the distributee partner. If you look on 341, distributions of cash. Generally, the general rule, and this is why we always have to be careful in tax, all of tax. We can say general rules, but then there's exceptions because we know generally when you contribute property to a partnership, generally tax-free, right? 721, but we also know sometimes, for example, when you shed liabilities, even when you contribute property, it can give rise to gain. Well, the same is true with respect to operating distributions, generally tax-free, right? Everyone agree? Generally tax-free. But sometimes, if there's a cash distribution in excess, Alan, is it inside or outside basis? Inside or outside, right, Alan? Got to nail it for the water cooler discussion, right? Outside basis. If you get cash in excess and outside basis, it can give rise, right, to taxable gain in that instance, right? All right. So we talked about distributions of cash. We talked about distributions of property, and then on page 43, a somewhat convoluted way that you're supposed to allocate your outside basis to the distributed property, okay? So you have to, if you're the recipient of property from a partnership, you have to apply these rules under 732, right, to the receipt of that property. And it's mechanical. It makes for, be forewarned, hear me, everyone listening? It makes for good exam questions, multiple choice. What is the partner's basis in the distributed property, right? So, does this come up in practice? Yeah, sure, all the time. LLCs and partnerships are distributing property all the time, all right? So, you should know these rules. First, the basis is allocated to the inventory and accounts receivable, and then, depending if there needs to be a reduction, there's special rules that apply. If there is still sufficient basis, then it's allocated to the other assets, the partnership's other non-receivables, the non-inventory, and then again, if there's a reduction, there's special rules for that. Marketable securities generally treated as cash. And then the authors give us some, I hope you agree, these are not challenging. I think they're kind of revenue rulings you can read and absorb. They're not hard to follow, at least in my opinion. I told you on page 351, we went through the first problem on page 351. I think it's a very doable problem. It's the kind of problem you can see that I might ask on the exam. Very similar in nature, right? Whereas there's, in this case, several different properties that are going to be distributed. I think in the first one, A, B, and C, the following assets, they distribute these different properties to the partners who have different outside tax bases. Okay, and they want to know the tax consequences.
Question.
Shoot.
Okay. When we allocate the basis to distributed properties, in that basically first is cash distribution, then second should be account receivable and inventory.
Yes.
Okay.
Both.
You cannot take directly to the capital asset. Okay.
No.
Number one.
All right. So that's where we left off. Here's our agenda tonight, guys. If everything falls into place, I hope it does, we're going to try, I'm not sure if we're going to finish, we will try to get to not only finish what are the consequences to the recipient, but beginning on page 355, what are the consequences to the distributing partnership, right? The challenge, the big challenge of tonight, we will find later in the chapter, not mixing bowl transactions. I think everyone will be able to handle that. The challenge and that gives people angst begins on page 367. Distributions which alter the partner's interest in ordinary income property, the so-called 751B issue. So be forewarned, that is the challenge. You'll see it's a multi-step process. It is not for the faint of heart, okay? So just know that in advance. If things fall into place, we'll see if we finish this chapter. If we do, great. My suspicion is we will not get through all the problems. For next class, we will begin our venture into liquidating distributions, beginning on chapter 11, all right? I posted, some of you have peppered me with questions. We had 3 more classes after tonight. I think we are comfortably where we should be. By the end of our next 3 classes, I feel that I hope you will have been well served because we'll complete the full life cycle of the corporate enterprise, the partnership enterprise from its inception, operations, and liquidation. All right, so hopefully you'll feel you got your money's worth. The exam itself, I believe, is on December 2nd, which is not a bad thing insofar as December 4th. I apologize. Why is that not a bad thing? Because of Thanksgiving, there will be a 2-week break that you will have, so that you will hopefully be able to really hone in on your partnership skills. And I am not leaving the country, and I will be around. So if you guys do have questions as you're going through the material, I will keep the partnership tax book near and dear to me. Even on Thanksgiving Eve, I will have it with me. All right.
Even if you left the country, we'd track you down.
Okay, that's true. That's true. There's no escaping. All right, any questions or issues, logistics or otherwise? All right, so I know it's Wednesday. Anyone, aside from the tax event, anyone do anything interesting this weekend that they have to share with the class?
Yeah.
We came to the tax event.
You came, but not everyone came. So I was just wondering. There was a question asked, we played Family Feud, there were several questions asked. One of the questions memorable, well, what family most resembles royalty in the United States? The number 1 answer was Kennedy's, but the Obamas were included, the Bushes were included. By the way, I did get Kennedy, but then when Solon said Washington, no, that did not cut it as royalty.
The Kardashians were number 2.
The Kardashians,
Oh my
Beyonce,
God.
and Jay-Z made the list.
Oh, yeah.
And then there's a question, I can't quite repeat the answers, but it was what traffic sign most reflects your love life? And there were some very interesting answers of what traffic signs reflected people love
Like
life.
red, green.
No, bump ahead.
Speed bump. That's what.
Speed bump ahead.
Speed bump was not the.
No, it was not a no. Yeah, it was
there,
not.
there were some other ones. Let's not get into it because it's probably not good to get on tape. All right, everyone ready? Question 2. Everyone, though, if you do not, let me emphasize this. If you don't understand question 1, that's not a good sign. So please review your notes for question 1. And if you get stuck in question 1, get back and reach back out to me, because then you may see that on the exam, and I don't want people to get frustrated. All right, so you got to know question 1, because then the other questions become that much harder. So you got to conceptually know question 1. So those people on WebEx, make sure you know question 1, please, on page 351. Let's get into question 2. Question 2 is a glorious question. Okay. Why, Viva? Because it gives you the pecking order. It tells you question 2 is glorious because it really, to the author's credit, it really highlights how operationally Code Section 732 is supposed to operate. Okay?
Is it exam worthy?
It is in its essence exam worthy. Okay? It's the Mona Lisa of distribution questions. Okay? It's a work of art. Ready? Partner has a $40,000 outside basis in a partnership interest. In a pro rata operating distribution to the partner, his partner receives 2 assets. Asset 1 has a value of $10,000, a basis to the partnership of $40,000, and asset 2 is a value of $10,000 and a basis to the partnership of $20,000. What basis will the partner take in each property under 732C if? So I'm going to minimize you guys on WebEx, and just look, guys. You guys have to be your own experts, but in my book, in question 2, I wrote the part just to be proactive in my book. You can come up during the break and look at it. I have it written down, and I have adjusted basis, the fair market value, asset 1 and asset 2. So, is there a gain or loss associated with these properties? Right? Everyone agree? They're built-in potential losses. Agreed? Asset 1 is inventory, and asset 2 is a capital asset. And you may want to, or can I ask, indulge. Can everyone open to Code Section 732? Allocation of basis under 732C. Okay, so I don't know, Viva, I can pick on you just initially, then I'll stop picking on you. Kevin, maybe you want to help Viva if you think she didn't get it. How are we going to allocate the basis here if you get asset 1 and asset 2?
First, should we, it's a billion loss, so whatever the loss, we have to take fair market value as a base of this.
But Vivi, you totally went over my head. I'm asking a simple question. What basis does asset 1 have?
Well, 40 over here, but we have to take 10.
Why? What's your authority for that? And Kevin, do you agree? No, these things couldn't be clearer in the code. They're, excuse my language, a little punchy tonight. So freaking mechanical. There's nothing left to the imagination here. Okay? This is not, we did not come tonight to use our imagination. Everyone agree? This is the most mechanical it could be. 732C1A, one little I. Okay? It says, everyone see that? 732C1, capital letter I. How do you allocate basis? First, to any unrealized receivables and inventory items, an amount equal to the adjusted basis. That's what it says, adjusted basis. Does it say fair market value, Viva? Everyone see that? So if we first allocate to inventory items, if it's distributed, we say use the adjusted basis. So what's the basis of the distributed inventory? 40, right? Because that's our outside basis. And what basis will we have then in the distributed capital asset?
20.
Hey, guys, we don't have any basis left.
Zero.
But for my mental sanity and to make my New Year's a good one, don't make that a mistake, okay? You can't allocate $60 worth of basis if you only have 40. Everyone agree? So it's a good mistake to make tonight, but please do not make that on the exam. So you allocate first the 40 to the inventory. That reduces the outside basis to what? 0. Now you distribute the capital asset number 2, and that's going to take a 0 basis. So if your notes for this answer, this is why this is a Picasso answer, right? It's 40 to asset 1, 0 to asset 2. Elizabeth, you don't look happy.
I know this is gonna totally trick me when you put it on the test.
I'm not doing it purposely.
I see where you're doing it, but in that moment.
I'm not doing anything special. I don't mean this. I'm taking it straight from the code.
I'm already dreaming about the exam.
I like the way you think.
No, well, it's a bad dream.
I'll leave it at that. I won't touch that. All right, you guys ready? Asset 2 is inventory. Asset 1 is capital. Don't say it out loud. Don't say it out loud. George is itching to say it, but Renee, you can have the honors. Just say it loudly. The people at WebEx, don't get mad at me. Get mad at Renee. Just tell me. I'll wait till we get out. I'm not going to respond. George is going to correct you if you're wrong. If you're not wrong, he won't correct you. I don't know what you mean. It's still 40,000.
Allocate 40,000 outside basis to the
You agree, George?
No,
You don't agree.
I don't know.
What should she have done instead? If this is inventory, it can only take a basis of 20, right?
Yeah.
Sandra, that's what you were going to say, right? Your hand jumped up. You can only allocate, it says, that's what the rule says. Under 732C, it says first you give it the basis it had in the hands of the partnership. So we're only going to give it 20 at most, right? And we can. Sandra, what are we going to do with the now capital asset number 1? What basis will it take? Say again? So give me a number? 20. So each asset will have a $20 tax basis, right? both properties are inventory properties. Don't say it out loud. Come up with a number for the asset 1 and asset 2 and why you came here.
Two thirds, right? Pro rata. No?
Yeah.
Pro rata, yeah.
Don't say it out loud. You got to work it out, guys. If you have my outline, how much total inside basis is there, Alan? 60. What's our total outside basis? 40. That means there's not enough basis to allocate, right? So we're going to have to reduce the basis of asset 1 and asset 2. Everyone agree? Because they're both inventory. Everyone agree? We're going to have to reduce the basis. Now the question is how? All right? The code tells you, right? Viva? Very mechanical. It tells you how to reduce the basis. My outline tells you, too. So now can you apply the rules of the code and what the authors tell you too? All right, the Kuzwa, it's the exam. What's the basis in asset 1 and asset 2? And Shannon, you want to tell us what answer you got, or Kuzwa can go first. All right, the Kuzwa. In some way, you're trying to say it's going to be close to 40. So I like the way you think. I'm not sure if I agree with your numbers. Shannon? You're not sure? Michael? Is it proportionate? Is that what it says? That's not what the code says. Okay? What the code says, David, you were going to say it's not outside based on outside basis, guys. Ken, you were going to say? What is it? What is it proportionate to? It's the phraseology is unrealized depreciation. Essentially, you have to reduce it. Unrealized depreciation, if you look at the examples in the regs, is based on the projected loss. Okay, the projected loss. Okay, we know we have to reduce the basis of the property received by how much? 20,000, right? Because we're getting partnership-based property with an inside basis of 60, and our outside basis is 40, right? Everyone agree? So we know, everyone agree? We're going to have to reduce that basis of the distributed property by 20. Agreed? Now, how are we going to reduce it by 20? It's based on the proportion of unrealized depreciation, aka potential loss. So how much potential loss is there here between these two properties? 40,000. Agreed? So 3/4, right? There's potential loss here, total of 40,000, right? Everyone agree? So 3/4 of that loss, or 3/4, goes to asset 1, or 15,000 of the loss. 1/4 times 20 goes to asset 2. So asset 2 would get 15. Asset 1 would get 15 reduced, which would bring it to 25. What's the total here between the two? 40. should be 40, right? Because that's your outside basis. Now, if you say, where the heck did you come up with that? If you look at the code, 732C1, we looked at A1, and we looked at AI, that was the first one we allocated strictly based on the adjusted basis, right? But then it says in 2 little I, right? 2 I, if the basis is to be allocated is less than the sum of the adjusted basis of such properties, then to the extent of any decrease is required, which it is, in order to have the adjusted basis of such property equal to be allocated in the manner provided in paragraph 3. So then we have to go to paragraph 3. So if you look at 732 C3A, method of allocating the decrease, first you do it, you see what it says? First to properties with unrealized depreciation in proportion to their respective amounts of unrealized depreciation before such decrease. And then, if you have to decrease it by more, then then you get into their adjusted basis. And we'll see in a moment how to apply that one. Right, so for your answers, guys, everyone see that? Question C? All right, we're on a roll. I don't know what your question is. This is the reduction of the basis in the property we receive. So when I receive asset 1, I'll have a basis of 25. When I receive asset 2, I'll have a basis of 15. Now, question D. Suppose they're both capital assets. I know you're excited now to figure that out. All right? Come up with a basis of each asset. David, you have a number? To both Davids. No? Does this look vastly different than what we just did? Because don't we just jump down a little bit in the code? Because 732 C1B, okay, says first we assign each property the adjusted basis. So each property here, if it were a capital asset, either would be assigned an outside basis of 40 and 20, right? But we don't have sufficient outside basis, agreed? So what it instructs us to do is that in this case, because it's a decrease, okay, it's not an increase, we have to go to paragraphs 2 or 3, so we have to go to the decrease, and since it's a decrease, we just get the same answer as we got above, right? Because we go back to the losses here, and we get the same thing. In other words, we're instructed, right, to now go to 732 C3 and just do what we did before. Look at the unrealized depreciation. Hey, you have a big question mark on your face.
Yeah. Shouldn't this one be allocated 2/3 and 1/3?
Why?
because,
What's your authority? Just tell me. where-
okay, the one below, B, blah, 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 B.
Well, I-
732.
Blah, blah, blah doesn't work for me.
Okay, the same stuff, 732C, 3B. Doesn't that say, it says it should be in proportion to to their respective adjusted bases?
No, but you skipped A. Don't, first you gotta do it with unrealized depreciation, and if that works, you stop there, you stop at A. And it works,
Even when they are capital assets?
absolutely.
Okay,
You're told to go right to 3, right?
okay.
We'll get to there, we'll get to where you want to, but this is not that case.
Okay.
All right, so the answer here, guys, is the same as above, for the reasons. First, we allocate, they get the full basis, but then it's reduced. E,
No, sorry, cancel, oh, same thing.
same. All right, there's someone who has a question on WebEx. I think they have a question. Or it just starts blinking after a while, I think. Okay. All right, question E. Suppose asset 1 has a value of 60 and a basis of 40 to the partnership, and asset 2 has a value of 50 and a basis of 20 to the partnership. What basis will partner take in each property under 732 if she receives both properties in a pro rata operating distribution and both properties are inventory items? Okay, so let's go question E. And in my notes, I wrote out, or in my book, I have a little chart here. Gain or loss. 20 and 30. Okay, she's gonna receive both properties in a pro rata operating distribution. And they're both inventory items. Alright, so guys, come up with a basis in her hands of asset 1 and asset 2. Don't say it out loud. Come up with a number. Take 30 more seconds, come up with a number. That is the exam. Anyone at WebEx? I know they say don't try this at home, but you're at home, so try it. And type in a number, asset 1 and asset 2. Vicky, Mike, Ovid, Carlo, Alvin, any of you guys? Simone, Peter? That's all the names I can read here. Anyone gonna be venturesome and type in a number for asset 1 and asset 2? You're gonna be greeted with silence. Alright, V, this has your name on it, and Aya, see if you agree with V. Asset 1 and asset 2.
I would distribute it by the gain-loss ratio. So 2/3 times 40 for asset 1, and 2/5 times 40 for asset 1, and 3/5 times 40 for asset 2.
Final answer, asset 1 is what?
2/5 times 40 is
16, right?
16, okay.
Did you agree? You do. Trent, you're not, is it Trent? No. I'm sorry, Tom, you're saying? Asset 1 at what?
At 32,000.
And asset 2 at what?
8,000.
Yep, same answer.
Let's think about this.
May I have
Viva,
No,
I have asset-
no, I don't have the same answer. Sorry.
Viva, go ahead.
I have asset 1 answer is 26,666 and the asset 2 answer is 14,333.
I think Viva's gonna get the award tonight. Viva,
Ooh.
how'd you get that?
Really?
Really? I'm taking Viva to Atlantic City with me.
Okay, so the total asset should, 60, 40 plus 20, 60.
Alright, so let's start with the code, right? Always a good place to start.
You're getting
And
lucky a
then
lot lately.
The starting point is we assign each asset its outside basis, that the inside basis becomes our basis. So the partner gets asset 1 with a 40 and asset 2 with a 20, but damn it, we don't have enough outside basis, right? So we gotta reduce it by how much?
I didn't reduce it. I just.
One. But how much do we have to reduce it?
Up to 40.
No. Well, we have to reduce it down to 40, which means we gotta reduce it by 20.
20, yes.
So we gotta figure out how to allocate that reduction. And Jonah, you got that? I saw by your face.
I'm sorry.
No. Well, you could raise your hand too. I mean, I don't see everyone's faces, so if you don't understand, remember, the partner here has an outside basis of 40. Everyone agree? And picture yourself, this is you. You are the partner with an outside basis. Everyone in this room, you're a partner with an outside basis of 40, and you're getting both of these properties, right? Good for you. That's nice. You're getting these properties. What's your basis in those properties? Now, you'd like to get a basis equal, or you would think the code initially does, gives you your basis in these two properties you're actually physically going to own of 20, or I should start with 40 and 20. Everyone agree? John, do you agree? You're going to have a basis in asset 1 of 40 and a basis in asset 2 of 20. And basis is a good thing, right? Minimizes your gain and maximizes your losses. But Jonah, life is not, that easy because you only had an outside basis of 40. So there's no way the code is going to assign you basis in assets equal to 60 total, right? You got me? You got these two assets. The most they can total, the outside basis, is 40. Initially, they're assigned a total basis of 60, so we have to reduce the outside the basis in these assets by what? 20. Okay? Now the next question is how to do it. And they do neither of these assets have a built-in loss. Everyone agree? And previously, we allocated based on the potential of losses, right? But now, we're in a different world. We're gonna have to allocate this decrease B. This is why I thought you would get this under 732 C3B. I'll repeat. 732 C3B. Because C3A doesn't apply anymore. Because now it says, to the extent such decrease is not allocated, because there is none, in proportion to their respective adjusted basis. So now we're going to use their adjusted basis. Well, what's their adjusted basis? 40 and 20. And that being the case, 2/3 of the reduction is going to asset 1. What's 2/3 of 20? That's how much, guys? 13,033. 1/3 times 20 is what? Is 6,060. Okay. So the total here is 20. And therefore, our basis reduction will reduce asset 1 to 26,667, and asset 2 will be reduced to 13,333. And the total, Jonah, has to be 40,000.
Professor Solon,
Yes.
how come we are not looking at 732 C2A and B for this?
Because that's allocating increases when the basis has to increase. We're looking at decreases to the distributed property. We're going to see that soon, but not
Their
right now.
FMB is higher, right?
No, we're reducing the basis. We're not increasing the basis.
Oh, okay, I got it.
The increase usually happens on a liquidation, not an operating distribution.
Yeah.
I didn't do that step. I just did this.
Well, do this step, Eva. All right.
did 40 divided.
Listen, I'm just following the code, okay? Again, at the risk of being boring up here, I am not doing anything other than just mechanically following the code.
How do you come up with the 2/3?
I looked at the basis. A1 has a basis of 40, A2 has a basis of 20. It says do the decrease in proportion to the size of the adjusted basis. What's the total adjusted basis of the distributed property? 60. 2/3 because of A, 1/3 because of asset 2. 2/3 because of asset 1, 1/3 because of asset 2.
And the 20 is because that's what we need to add it
Jonah
up.
would tell you we got to decrease overall by 20.
Because that's what we need to.
Get down to 40. That's the most we have. That's our cap. That's our outside basis.
You got it.
Okay? This should be a feel-good problem because it's the Picasso distribution problem. And you can see mechanically how code section 732C operates. But it's a recipe for disaster if you don't get like these little nuanced rules. That's why I typed it out. But again, I encourage you to do it yourself because by doing it yourself, you'll see how these rules operate. These are spelled out, by the way. Again, if you don't like what I prepared, which is fine, I keep emphasizing, these rules on page 343 are spelled out in detail. Page 343, spell them out on how to reduce. Ready for question 3? You people on WebEx, being a little chicken, if you don't mind me saying so. I don't think we got one person to type in a possible answer. Let's see, let's go to the video. No, not one person had the guts to type in an answer. All right, you ready for question 3?
Because it's,
All right, someone's typing in something here, I think. Trying. Okay, Peter, we appreciate you trying. All right. Question 3. New partner purchases a 1/3 interest in the following 3-person equal partnership for $40,000. At the time of the purchase, the partnership had the following partnership assets. The partnership made no 754 election and immediately distributes $10,000 receivable to each of the three partners. By the way, notice, and when we talk about code section 751B, notice in every single one of these problems, I just call this to your attention because otherwise it goes over you. I'm just calling to your attention. Each one of these problems, the authors emphasize that there's a pro rata distribution among the partners. It's not disproportionate. Because where there are disproportionate distribution, we might have the application at the end of this chapter with 751B. So just make a mental note that every one of these distributions thus far in the chapter until the very end, they're all proportional, all right? Everyone's getting the same distribution. And there could be a problem if someone gets something different, okay? Let me give you that foreshadowing. So all three partners get $10,000 receivables. What results in new partner in the collection of the receivables if new partner makes no 732D election? So if the new partner gets the receivables, what's new partner's basis
40.
in the receivables?
Oh.
So then,
What's the receivables, Viva?
10,000.
Why would it have a $10,000?
See.
What's the inside basis?
Zero.
Zero. So what would the partner?
Zero.
Zero, right? Everyone agree? That when you get the receivables, the partner would take a basis equal to the distributed under 732, just A1. Right? What happens when they were collected?
It will reduce his basis after payment.
Would it? And he owns the receivables now. It's not. Once you get the receivables and you own the property, guys, there's no more further effect to the partnership. So when the receivables are collected, what happens?
Ordinary income.
You would have 10,000 of ordinary income, right? And his outside basis would remain at 40. Is new partner a happy camper? No, new partner is kind of frustrated. Did he have any true economic gain? No. So he's not a happy camper, or she's not a happy camper. What results on the collection of the receivables if new partner makes a 732D election? What does 732D election do? It's like your own personal 754 election, right? So that you get on distributed property, you get the inside basis you would have had, right, had there been a 754 election. But this is only effective if the election is made within 2 years of your purchase. So if there's a 732 D election, then what would be our adjustment here under 743? Without getting fancy, guys, you can eyeball it. How much would the receivables? You would have the inside basis to this partner would have been 10,000, right? So on the distribution, he will take a $10,000 basis, right? Under 732, A1, he would get a $10,000 basis in the receivables, and therefore, when the receivables are collected, any gain or loss, guys? No gain or loss. Agreed? No gain or loss. What happens to his outside basis, though?
It will reduce.
Be reduced under 733 down to 30,000, right? Question C. Well, I think we just answered question C. Must the partnership approve of the election, guys, or is this done at the partner level? It's done at the partner level, right? Question E. Will the election have any immediate effect on the basis of new partners' interest in the land remaining in the partnership? The answer is no, right? This only, 732D election only affects distributed property. It's not like a 754 election, right? Which has an effect on the remaining property as well. If you make a purchase, the 743B adjustment has a bearing as to all the property. Here there would be no rippling effect. The basis, the inside basis of the remaining property would remain the same. All right? So guys, we just spent literally, and I think it's time well spent, over an hour going through 2 or 3 problems dealing with distributed property. But it's something that happens all the time, and you have to have great command over it, right? So just think about that for both the exam as well as in your practice. All right, so you ready to move on? Any questions? WebEx folks or people in the room? Any questions on this material? And let's look at code section 735. Remember when we contributed property into a partnership? Just before we turn to 735, you guys remember in chapter 2, we looked at code section 724? 724 talks about when you contribute property to a partnership, when you contribute property, that its character remains intact if it's inventory or accounts receivable, right? Its character remains intact, and capital loss property as well. It remains intact. 735 is the analog to that. What do we mean by analog? When a partnership distributes property, guess what? Reminds me of Justin Timberlake. What song does he sing? What goes around comes around. Everyone knows that song? Well, what goes around comes around. We have 724 and 735, right? 735 says, hey, when the partnership distributes property, the unrealized receivables and inventory are going to maintain their character, with the caveat the inventory retains its character for 5 years. There's a 5-year taint associated with the inventory. Can you shed recapture income? Our favorite code sections, 1245. Can you shed it? Can you somehow get rid of it by distributing it from a partnership? And the answer is no. 2 letters, no. Or in Russian, yeah. Okay? So everyone got that, right? Not surprising. Congress at some point doesn't want to use partnerships for gains. On page 730, on page 354, there's a discussion of tax holding periods with respect to the distributed property. Okay? Tax holding period in the hands of the recipient. Okay, let's look at the problems. They're very simple problems on page 354. A partner in ABC cash method partnership has outside basis of 10,000. Okay, in a pro rata operating distributions to the partners, A receives a parcel of land held as inventory. Okay, it's inventory in the partnership with a basis of 2,000, book value of 3,000, and 0 basis accounts receivable, the value of 3,000. Both properties become capital assets in her hands, which is kind of weird to have accounts receivable, but go with it, just for your imagination. 6 years later, she collects the receivables and sells the parcel for 3,000. What are the tax consequences to A of the distribution and the collection of the receivables and the sale of the parcels? what basis does she take in the receivables and the land, guys? Say it loudly, Viva.
From the inventory 2 and the account receivable 0.
Okay, what's your authority for that? She has a fairly significant outside basis. Everyone agree? She has $10,000 of outside basis, right?
Yes.
And therefore, since she has a pretty robust outside basis, and the distributed property here, the land, has a meager $2,000 inside basis, and the receivables have a 0, each one will take a basis equal to the inside basis. So in her hand, she'll have a basis of 2 in the land, 0 in the accounts receivable, by authority code section 732A. What's her outside basis as a result?
8.
8, right? Code section 733. Our basis will go from 10 down to 8, right? Because we're going to use 2 of our outside basis allocated to the land. When now it's in her hand, she gets the accounts receivable. How much income will she have? 3,000, right? What's the character? Ordinary. 735 taint remains. But the inventory, which is no longer inventory in her hands, it's a capital asset. What's the character? She'll sell it for 3. What's her basis?
2.
2. Gain of $1,000 gain. What's the character? What's the character?
Operating. Ordinary.
No, it's a 5-year taint. Here is sold in
Oh,
year 6.
that's right. Okay.
Ah,
Capital gain. Okay.
capital gain. Everyone got that? And kid, you got that?
Yeah.
All right. What result if immediately after the distribution, A gives a parcel to her daughter, D? Do you have any income? You guys say no, right? Code section 102A. What's D's basis in the property? What code section for gift? I don't see Simi or Isabel. Right. The Kuzwa, you're here from income tax. What's the basis? What code section? Alan, you too. What code section for gifts? 1015, guys, come on. 1015. Carry over basis, right? Gain or loss on the sale? What do you mean no?
Sorry.
Well, yeah, you
The
still.
daughter now sells the property, right? What's her basis? 2. What's the amount realized? 3. Gain of?
1.
1. What's the character?
Capital.
Well, the question is, does the taint still remain? Because now it's in daughter's hands. She's not a distributee. Can you shed the tainted gain by making a gift? Look at code section 735C2A. 735C2A. If you have a substituted basis, right? Isn't the daughter taking over mom's basis? So the taint will remain. You can't get rid of the taint by just making a gift and having that other person sell the property. Well, it's going to be ordinary income because it's within the 5 years, right? So for your notes, 1,000 ordinary income, right, Ramon? You got that? Simone, you said no. I'm not sure. I apologize, but I'm not sure what question you were responding to when you have no in no all caps. I apologize. All right, question 2. A and B operated taxi business as partners. In the current year, the partnership distributes to A, a taxi purchased over 1 year ago for $5,000, which had an adjusted basis of $2,000, okay, and a value of $3,000. So presumably there was $3,000. If you get the visual here, they bought it for $5,000, took $3,000 of depreciation, right? So that reduced the adjusted basis down to $2,000. Agreed? And it has a value of $3,000 when it's distributed. A's outside basis is $1,000. And now just notice the parenthetical. To make 751B inapplicable, you're going to have an identical distribution to B. The disposition of the taxi is not a taxable event to the partnership, okay? Right? It's not going to give rise to a taxable event. What are the tax consequences if A immediately sells the cab for $3,000? So the question is, A's going to sell the cab for $3,000. This is a 1231 asset. This is a depreciable asset. What basis does A have in the taxi cab when A receives it, guys?
2.
Why do you say 2?
Oh, 1.
1. Guys, be very careful. Everyone understand your outside basis sets the cap on what is the maximum basis you can have in distributed property, right? If the outside basis is 1, and this cab is distributed, even though it has an initial basis of 2, the basis will be reduced to 1. Everyone agree? Yeah. I never say it right, do I? No, I don't. How should I say it? RD top.
Yeah.
3 syllables. RD top. RD top. You agree? Cannot be above the 1, right? That's the ceiling. Gavin, you agree? Yes. Now she's going to sell it for 3. Code section 1001. Amount realized is 3. Basis of 1. Gain of 2. Right? So far so good. Everyone's smiling and saying, "Oh, that's easy." And here's the challenging part. What part of that gain is recaptured?
1,000.
Now you might say 2,000 because what's the potential if the partnership simply sold the asset?
1,000. If the
If the partnership sold it, it'd be 1,000, right? A 1245 gain. And you might think, right? Everyone agree? If the partnership sold it, it would be 1,000 1245 gain, right? And that pretty much is what happens here. Is if you look at code section 1245, B5, capital letter B, 1 little y. I'll repeat. Code section 1245, B5, capital letter B, 1 little y. In that case, if you read that, okay, recapture, right, Simone? Is that in that case, it will cap the amount of 1245 gain in this instance, $1,000. So A would have 1,000 and 1245 gain and 1,000 of what kind of gain?
Capital.
1231 gain. Be careful because it's 1231 gain because it's a depreciable asset, and you guys know from your income tax course we have to see if the gains exceed the losses or the losses exceed the gains. Right?
Oh my God.
And of course, what would life be if we didn't see if there's 1231C to recapture, right? To close off. So we just had to make sure in the prior 5 years where there are 1231 losses.
But for purposes of this question, it's capital gain.
1231 gain,
Oh,
all right?
okay.
Which ultimately may be capital gain, right?
Right. I forgot the other stuff already.
Don't say that.
Only 1,000, it should be recaptured, right?
1,000, 1245 gain. All right? consequences to the partner receiving property. Everyone understand? To the partner receiving property, we saw that there could be gain, no losses on an operating distribution. And then we saw what would be the basis of the property the partner received. And we saw code section, the application to code section 735. The next section looks at, entitled on page 355, consequences to the distributing partnership. And once again, this could be a very simple rule. Emphasis on the word could be. Because Tom would say 90% of the time when a partnership makes a distribution of property, Tom, any bearing on the partnership, the remaining property of the partners? And the answer is 90% of the time, no effect, right? So on page 355, the authors say there's a non-recognition rule, and impact on inside basis, it says, turning to the partnership's balance sheet, 734A sets forth the general rule that distributions of property do not affect the inside basis of the property retained by the partnership. That's the rule. No effect. And the authors point that out vis-a-vis an example. But now, if there's a 754 election, because we know there may, if you make a distribution, depending on if cash is distributed or other property is distributed and partners outside, there may be a difference between the outside and inside basis. So if you look at the bottom of page 356, notice on the balance sheet, that partnership has inside basis of 3, and the partners, B and C, who remain, have a basis of 6. Everyone see it lacks symmetry? If there's a 754 election, 754 to the rescue will recreate symmetry, for better or worse, and there will be a so-called 734B adjustment, just like we had before. When there was a purchase of a partnership interest, there was a 743B adjustment. Now we're going to turn it to a 734B adjustment. 2 different code sections. But the process is very similar. You decide what is the 734B adjustment, and then you use code section 755 to allocate that adjustment. Okay? Two-step process. Two-step process. And the authors on the bottom of page 358 talk about how to allocate basis when there's an increase and how to allocate basis when there's a decrease. That's spelled out on page 358, and it continues on to page 359. And that first paragraph on page 359 gives further implications. So those are 2 very good paragraphs to read. 358, the bottom paragraph that extends to 359, and then on page 359, that first whole paragraph. Now, the authors point out on page 359 that these distributions require adjustments in the capital accounts. That capital accounts, as a result of these distributions, have to be adjusted. Adjusted by what? You have to take into account that you have to look at the fair market value of the property being distributed, right? Because that represents an economic decline in the stake the partner will have in the enterprise, right? By receiving this property, the partner is going to have a smaller, right, economic stake in the enterprise. And our capital accounts are key, right? Are key to knowing what those economic stakes should be. So they will have to be adjusted. on page 360 and 61, there's a problem to help illustrate this. So what we could do, but I think you guys should get your caffeine fix, is that before we indulge in this problem, you should take a break. Now, here's the objective, guys. We're going to do this problem. If you look at mixing bowl transactions, we're going to talk about them and the implications. And on page 366, there is one problem that helps illustrate when these rules come into play. These are safeguards against taxpayers playing games. And then we will launch into a discussion about 751B, which singularly can drive students and practitioners nuts. In my perfect world, we'll try to get through at least problem 1 on page 380, because by getting through one problem, I'm hoping it will make it easier to get through the other problems. And then we'll be in a good position to start a discussion about liquidating distribution. So why don't we take our 8 or 9 minute break, come back here refreshed, and we can start off with this problem about seeing how those rules operate. All right? So, and anyone who wants to pick up their midterm exam,